Welcome back to Explain the Charts, where today, July 29th, 2025, we're taking an in-depth look at the S&P 500, ticker SPY. Recent headlines are painting a mixed picture. On one hand, we've seen SPY and Nasdaq eke out new records, with some reports even suggesting a potential 7-day winning streak. However, the enthusiasm from a new EU trade deal appears to be short-lived, with the S&P 500 closing largely flat yesterday, failing to spark a significant rally. The market is now bracing for a crucial week, with Magnificent Seven earnings reports and a highly anticipated Federal Reserve decision on the horizon. Adding to the complexity, various market models, like the S&P 500 mean reversion model, are flagging SPY as significantly overvalued as of March 31, 2025, trading 60% above its historical trend. Guru Focus's GF value also echoes this sentiment, indicating that the current price is significantly above its intrinsic value, implying lower future returns. Conversely, Capital Economics, a highly accurate forecaster, maintains a very bullish long-term prediction, eyeing SPY to reach 7,000 by the end of 2025. This creates a fascinating divergence between short-term valuation concerns and long-term growth expectations. Now, let's turn our attention to the daily chart to understand SPY's journey. Looking at the period from March 2024 through July 2025, we can clearly see a strong overall uptrend, pushing to fresh apex heights. However, observe the sharp correction that occurred around early April 2025. During this period, specifically from April 3rd to April 8th, SPY experienced a significant drop, falling from around 564.52 to lows near 496.48. This 11% decline, accompanied by a notable surge in trading volume, suggests a period of intense selling pressure or a market reaction to some significant, unmentioned event at the time. This kind of volatility serves as a stark reminder of how quickly sentiment can shift, even within a broader uptrend, especially when major economic news or earnings are looming. Following that April dip, the market showed remarkable resilience, recovering steadily and establishing new all-time highs into July 2025. The current resistance level for SPY is firmly established around the 637 to 638 mark, a level that has been tested in the last few trading sessions. This level represents the recent all-time highs and will be a crucial point to watch for any breakout or reversal. On the downside, the 620 to 622 region, which served as a consolidation zone in early July, now acts as immediate support. Below that, the 570 to 580 range, encompassing consolidation points from October-November 2024 and March 2025, represents a stronger intermediate support area. The major support from the April 2025 crash, around 495 to 505, remains a critical long-term level to monitor, though it's quite a distance from current prices. Shifting to the 1-hour chart, we get a closer look at the market's more immediate movements over the past few weeks. You can see that recent consolidation around the 620 to 625 level in mid-July was followed by a fresh push upwards towards current highs. A notable event on this time frame was the large volume spike and wide-range candle on July 16th, around 1500 hours Universal Time Coordinated, which saw prices dip significantly before a partial recovery, indicating a strong intraday battle between buyers and sellers. This highlights the increased volatility we often see around market-moving events or technical levels. Now, zooming right into the present with the 15-minute chart for July 28th, 2025, we can confirm the market's reaction to the recent news. After opening around 639.2, SPY saw some early dips to 638.02. For the most part, the day unfolded with tight consolidation between approximately 636.9 and 637.4. This aligns perfectly with the news reports indicating that the S&P 500 closed largely flat as the EU trade deal failed to ignite a significant rally. The muted response suggests that despite the positive news, market participants are exercising caution, likely awaiting the major economic catalysts due this week. So, what does this all mean for trading SPY? In the short term, reasons to be bearish stem from the overvalued assessments by both the mean reversion model and Guru Focus's GF value. These models suggest that current price levels might not be sustainable, pointing to a potential correction or a period of underperformance. The flat reaction to the EU trade deal reinforces this cautious sentiment, implying that even good news might not be enough to sustain the upward momentum at these elevated levels. The upcoming Fed decision and Mag 7 earnings reports are major wildcards. Disappointing results or a hawkish Fed stance could trigger significant downside volatility, similar to the April 2025 drop. Watch for increased volume on any sharp downward movements as a confirmation of bearish pressure. Conversely, there are compelling reasons to be bullish in the long term. The sheer momentum of the current uptrend, which has been robust since the April lows, is undeniable. Furthermore, Capital Economics' bold prediction of SPY reaching 7,000 by the end of 2025 offers a very optimistic outlook, suggesting significant upside potential if their analysis holds true. Positive earnings from the Magnificent Seven could provide the necessary fuel to break through current resistance levels and continue this rally. For long-term investors, dips towards established support levels could present buying opportunities, especially if fundamentals remain strong and economic growth continues. A sustained break above the 638 resistance with strong volume would be a key bullish signal. To recap, here are the crucial price levels to watch. The immediate resistance is around 637 to 638. A sustained breakout above this, ideally on strong volume, would reinforce a bullish outlook, with targets potentially heading towards the 650 range and beyond. Immediate support lies at 620 to 622. A break below this could signal further retracement towards the 570 to 580 level. The long-term critical support from the April lows around 495 to 505 remains a safety net, though far removed from current trading. The likelihood of a continued rally to 7,000 by year-end, as predicted by Capital Economics, is plausible if earnings broadly impress and the Fed's stance is perceived as accommodative. However, a significant market correction is also highly likely if the overvalued concerns materialize, especially if tech earnings disappoint or the Fed delivers a hawkish surprise. Keep a close eye on the volume. Large spikes on down days or low volume on rallies could indicate weakness. Also, monitor the news closely for any shifts in sentiment regarding the Fed, inflation, or geopolitical events. These factors will dictate SPY's path in the short to medium term.